Bitcoin nuked to $80,000 overnight, bringing the rest of the market with it. But how much worse can it get? And what happened in Tokyo that could have added to this bloodbath? This is your Altcoin Buzz News. Hey, what's up, everyone? My name is Cody, and if you're new here, make sure to like, subscribe, and turn on notifications so you know when we drop latest content. Follow us on Twitter, AltcoinBuzzIO, and as always, is not financial advice, and wish the best of luck in your crypto ventures. Also, make sure to join us for our X Spaces Tuesday to Friday at 9 a.m. EST, link down below. All right, good morning, guys. Unfortunately, Bitcoin has continued to sell off. It was just last Friday that I was telling you guys that I was getting out of altcoins around this 50-week EMA, which is this line here around $100,000. We were starting to lose this, and historically, when we lose this line, it is the end of bull markets, especially if we close 2 weekly candles below it. This was the first weekly candle, which we closed last week, and now we have about 2 days and 11 hours to the next one. So we're about 20% down from this point here. And it's not looking the best right now, but I'm going to go over some reasons why we could see a potential pump in the coming month or two. And we also have a video from Joe coming out very soon on TA. And in his video, he talks about how we could be going down to this 75K level, which I do think is a possibility. It's the next major level of resistance here, which was prior all-time highs, flipped into support here. And so this big blue box now is the next level of support between 71 and around $78-ish thousand. I do see that as the next level. I mean, we got pretty close here. We went down towards around $80,000 overnight, and now we're kind of bouncing this morning, which is to be expected because we've just had no bounces. It's essentially just been down only for the past week or so. So we're gonna get into a couple reasons as to why, and I talk about all this. First off, for perspective, when FTX collapsed, there was extreme fear at 12, and now we're sitting at 9 on the extreme fear at $91,000. This was actually yesterday. And so before, when Bitcoin was at 21K, we were at extreme fear. We're actually lower than that right now. Now we have Shanaka, who says the global financial system just broke in Tokyo. Japan's 30-year bond yield hit 3.41% today. The number means nothing to you. Here's why it should terrify you. Japan owns 230% of everything it produces. It's the most indebted nation in human history. For 35 years, they kept the lights on by borrowing at near zero rates. The era has ended this morning. Here's what just happened. Core inflation is running at 3%. Government bond yields are spiking to levels not seen since 1999, and China just conducted its 25th military incursion near Japan waters this year. Japan is now forced to spend 2% of its GDP on defense, nearly 9 trillion yen annually. The Bank of Japan is trapped between two impossible choices: raise rates and trigger a debt collapse, or keep rates low and watch inflation destroy savings. They chose door number 2. Why you should care: every major bank, hedge fund, and institution on earth has borrowed yen at cheap rates and invested it elsewhere for 30 years. This carry trade could be worth anywhere from $350 billion to $4 trillion. Nobody knows the real number because it's hidden in derivatives. When Japan's system breaks, this money unwinds fast. The last time we saw a preview, July 2024, the Nikkei dropped 12.4% in a single day, and the Nasdaq fell 13%. That was a small tremor. The earthquake is coming. The math is simple. Japan's government pays interest on $9 trillion in debt. Every 0.5% increase in rates costs them $45 billion annually. At current yields, debt service will consume 10% of all tax revenue. That's the death spiral threshold. The yen is trading at 157 to the dollar. If it strengthens to 152, the entire carry trade becomes unprofitable. Unwinding begins. Emerging market currencies could drop 10 to 15%, and the Nasdaq could fall 12 to 20% as funds are forced to sell. So what happens next? Well, December 18th and 19th, the Bank of Japan meets. Markets are pricing at 51% odds they raise another 0.25%, and if they do, volatility explodes. If they don't, inflation accelerates and the problem gets worse. There's no way out of it. Japan's fiscal dominance is now permanent. They must keep the yen weak to service their debt. This means that free money that powered global markets since 1990 is ending. The bottom line: interest rates worldwide are going up 0.5 to 1% permanently. Not because of inflation, because the world's largest creditor nation can no longer subsidize global growth. Your mortgage, your car loan, your credit card are all repricing higher. Stock valuations built on cheap money all compressing. The everything bubble all deflating. This is not a recession. This is a regime change. The largest liquidity engine in financial history just seized up, and most people won't understand what happened until their portfolios are down 30%. Tokyo broke the world today, and you'll feel it tomorrow. So there's a lot there, but in short, it's like what happened last year when we came down here towards $49,000 on Bitcoin, when this yen carry trade started to really unwind and everyone started to hit peak fear. I do think we are probably at that point very soon. If we come back down here towards $75,000, I do expect some kind of a bounce because we are really at peak fear right now. So I don't think we continue just straight down. I do think we are in for a bounce at some point, even though I know I've been saying that. But we are really reaching that peak fear area right now. And we also have Mike Alford saying a source has confirmed that several senior banking executives have called Fed Chair Jerome Powell today to express grave concerns about the potentially disastrous trajectory of Japanese monetary policy and the need for an early rate cut and return to a larger scale QE. At the same time, Jacob shares that Nakamoto's Naka has just dumped 367 Bitcoin worth over $35 million. We're in the phase now where all the treasury companies who bought Bitcoin are now facing major losses and will be forced to dump. This bear market is going to be much worse than any before it. So right now we're starting to realize that a lot of these companies are starting to sell all these digital asset treasuries. They are starting to sell because unlike retail, they don't just hold to zero. They don't just wait for a price to keep going down. They have, investors they have to appeal to. So a lot of these companies are starting to sell right now. Mining companies, digital asset treasury companies, a lot of them are starting to sell, which is why we're seeing this, continued cascade and no real big bounce yet. We also have another interesting take here from Sightbringer who says the truth about the 9:30 a.m. Binance seller pattern. First, the pattern structure. A single actor or tight cluster aggressively selling Bitcoin at exactly 9:30 a.m. EST when New York opens every day, with the same signature size, timing, and execution style on Binance futures for roughly 2 weeks straight. That never happens by coincidence. Retail doesn't behave like this. Whales don't behave like this. This is systematic flow. This is mandated execution, and the regularity to the minute tells you it's professional, not emotional. This is not an attack, it's a mandate. When flow is this clock time, there are only 4 realistic possibilities. Possibility A is structured unwind. A fund or desk is cutting risk, deleveraging, or liquidating part of a book inside a fixed window of execution. Possibility B, hedging schedule. A large actor is hedging spot inflows and outflows on a fixed schedule. This also results in repeated selling at the same time, regardless of price. Possibility C, coordination group action. A syndicate of desks decides this is liquidity window, this is the execution box, and they pile in together. And possibility B, a disastrous actor unwinding inventory. This could be a market maker, a proprietary desk, or a larger whale who must sell at regular intervals because they're unwinding on a bad position. And this aligns with the liquidity fracture that began on October 10th. Now, the key fact, this does not look like a healthy seller. Healthy execution does not dump into thin books, dump in a falling market, dump during volatility spikes, dump at the exact same venue, dump at the exact same clock time, or dump with zero sensitivity to price or slippage. Healthy sellers spread their flow. This seller is not spreading flow. That tells you they're constrained. They're required to sell at this time. They don't have the luxury of being smart. They're cleaning up a problem, not expressing a view. This looks like a forced participant, not a bear, not an attacker, not someone who believes price is going lower, someone who has to unwind. This is why the flow looks so synthetic. This also aligns with everything else we've seen. It perfectly fits into the October 10th liquidity fracture, the broken depth that never fully recovered, the weird slippage behavior, the Bitcoin only stress, alts didn't sell as much mechanically, the US panic zone, the ETF redemptions, the shallow liquidity regime, the market maker deleveraging, and the whales absorbing. All these point to a damaged microstructure and forced flow, not to new bearish fundamentals. The final synthesis, this seller is a residual echo of the October 10th failure. They're cleaning up a mess, not expressing bearish conviction. This is not someone betting on lower prices, it's someone being forced out. So that's also part of the reason at this point where TA starts to kind of break down. It's a bit harder to predict TA when the person who is selling needs to get out and has to sell, which is what it very much seems like. There is no reason that we're just slicing through these levels of support so fast, because someone who is smart about this and wanted to actually, make money, not just lose it very easily, wouldn't be just dumping price like this every day at New York Open. So we don't actually know what happened on October 10th, but we have Tommy Lee saying the real reason Bitcoin and ETH has been bleeding since October 10th is a massive liquidation shock and crippled by market makers. So he gives his reason for this.
Crypto market has been limping along since October 10th because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities. because of that unwind and now this sort of limping and weakened liquidity.
Now, at the same time, we have the Cardano founder, Charles Hoskinson, who says that Bitcoin is still going to 250K by next year, which is 2026. So by the end of next year, he still thinks we're going to go from 80,000 to 250K, saying this.
And crypto's not immune to the macro. We're still dealing with issues from the tariffs. We're still dealing with a great degree of economic uncertainty. Just this year was a little lackluster, but overall, I'm still very optimistic in the next 12 months. I think we'll clear most of this downside the next 2 quarters, and we'll be back up to $250,000 Bitcoin by the end of 2026.
And lastly, on this point, Lark Davis shares President Trump is planning $2,000 stimmy checks. Japan is preparing for a $110 billion stimulus package. China is giving $1.4 trillion stimulus package. The US is issuing 1.9 trillion treasuries every year. The Fed is about to end QT. Canada is starting QE. Global M2 money supply is sitting at record highs. So much liquidity is about to flow into the market. Do you think these are signs of a bull market ending? So that is the kind of counterpoint to this, is when all of this selling stops, when this big seller potentially gets out of the market, and we have all this money and liquidity flowing in, going in towards, the new year, we could have a very big rebound. Doesn't mean we can't see more pain first, but it does leave the possibility that the bear market isn't here fully. This is just a really rough period of time, kind of like the in-between in 2021 when we had between May and November, when there was like a really rough time when we sold off from, where was it? When we sold off from, was it $65,000 down to $30,000, and then we went back up to $65,000 a month later. This could be that kind of a rough period in between. And it doesn't mean that the bear market is necessarily here. It just means this could be a very rough time. But this is also not to say that it is guaranteed that something is going to happen in Q1. And then lastly for today, we have Falcon Finance unveils staking vaults for productive holding. So Falcon Finance staking vaults give long-term holders a way to keep exposure to their assets. They also let users earn a yield paid in USDF, a synthetic dollar built for stable on-chain use. This launch comes as more investors are looking for simple ways to earn dependable on-chain income. A recent report from Binance Research shows that the passive yield products have grown in popularity this year, especially among beginners who want predictable returns without giving up ownership. Falcon's new vaults tap into this trend with a clean, beginner-friendly design that keeps users in control of their assets. And Falcon already offers 2 earning paths through its Earn suite. Classic yields let users stake USDF for the FF token with no lockup. Boosted yields give higher returns when users lock their USDF or SUSDF for a set period. The new staking vaults add a third option. Instead of staking only USDF, users can now deposit tokens they already hold and earn USDF directly while staking exposure to their assets' market movement. The first supported token is FF, the governance and utility token that powers the Falcon ecosystem. So that is Falcon Finance's new staking vaults, and that is the video for today, guys. We're hovering just above $84,500. Also, make sure to check out Joe's latest TA video on where he sees us going in the near term and towards this $75,000 level of support. But that is the video for today, guys. I hope you enjoyed. Hope you stay safe out there, and I'll see you on Monday.